let's get reaction to the market close. Jeremy Siegel, Professor of Finance at the Wharton School of Business and Chief Economist at WisdomTree. Very good to see you, Professor, as always. Long time no speak. I just wonder whether you see a little bit of a close today. It's only one day's close, of course, and you think, yeah, that makes sense because we're on track, whether we look at it 10% up year to date on the S&P 500 or one statistic that jumps out to me, we're on track for 5 months in a row of gains. Are we due a little bit of a pullback?
Well, I wouldn't be surprised, although I still think the momentum is there, Will. I still think this bull move is strong and has a ways to go. Yeah, I mean, you could have little corrections under the way, kind of head fakes, but I think the news is strong. I think the inflation is going to be being reduced. I saw a GDP estimate by the Atlantic Fed. This came out after the durable goods at 2.1%, exactly the target of the Fed this year. So the economy is not showing signs of weakness. And surprisingly, 12-month earnings forward, instead of usually they go down as the year goes on because they're often overestimistic, are actually rising in many circumstances. So I still think, yes, we could have even a 5% reaction, but I don't think this bull market is over.
Well, let's talk about inflation and what, of course, that then feeds back into rates in the market, because obviously we get PCE on Friday when the market will be closed. Well, earlier today on Squawk on the Street, excuse me, it's been a long day, Professor Siegel, I was talking to James Gorman. Let's hear his take on rates.
I would be surprised if they move in the first half of this year. I would not be totally shocked if they don't do anything for the rest of the year.
Professor Siegel, no rate cuts at all this year. Do you think that's possible? What would it do to markets?
It is possible. Torsten Slok is another economist who came out with that a couple weeks ago, and I think it's unlikely. I think it's against the odds. But very honestly, what's more important for the market is the state of the economy and earnings going forward, to whether the Fed lowers it in June, July, or even December, as the case may be. Now, I still think the odds are definitely that they're going to lower it, but I think people are beginning to realize that they're going to be buying stocks for earnings more than what the timing of the Fed rate cuts are actually going to be.
So if we step back, whether it's in the short term and the S&P's up 10% this year despite rate cut expectations coming down significantly, or longer term since the sort of October 22 lows, do rates not really matter and multiples for stocks will kind of ignore rates altogether?
No, multiples, they matter. I think we're looking at 21 times forward earnings on the S&P. Now, that is slightly rich. I've often argued that about 20, I thought, is the equilibrium. Now, of course, if you take out the Mag 7, you're down to about a 17 and 18, which is, more reasonable. I still think we have a bifurcated market here. And that doesn't necessarily mean it's bad, because those stocks have generated the bulk of the growth of the earnings. But when I look overall at the market, I say, no, it's not cheap. But it certainly is not something that I think any long-term investor should avoid. And particularly even an intermediate-term investor, I think, is going to be rewarded.
I wanted to get your take on gold, which, of course, has broken out to highs recently. At the same time, of course, Bitcoin and cryptos surged once again. Are those sensible investments at the moment?
Well, the long-term return on gold is 0.9% after inflation. And that's over 200 years. So you can certainly get a spurt in the short run, but in the long run, it pales with respect to almost all the other assets. It's a store of value, and with a little bit of gain beyond that. Now, given all that, You know, I was really excited about gold early when inflation started, and it didn't move very much, and everyone went to Bitcoin. And I sort of said, yeah, you know what? The millennials' new gold is Bitcoin. They're not interested in gold much anymore. It was really a disappointing investment at the beginning of this inflation period. But I think it's in a catch-up mode right now. But I really am not a fan of gold as a long-term investment.